Hi everyone, I'm doing a live off my desktop, but I wanted to go through some of the things which I covered on my trading and investing summer school. I thought it'd be a really good way of just giving you an overview, sharing some of the information with people. I'm not going to go through absolutely everything. What I'm going to do is just talk about some of the key things that I covered on there. And there's a ton of stocks which have gone up. There's a ton of over the last 6 months on the UK and the US, but that isn't the problem. Of course, we know there's lots of stocks which have gone up. The major problem is what about the risk? Let me just address some of those issues. This, by the way, what you can see on screen, that's what $100 million would look like if they were stacked up in dollar bills. That's what it would look like, okay? And on the other side, you see US national debt. If that was stacked up to give you some perspective, there's a heck of a lot of dollars out there. And the concern is that that should mean a plunging dollar and a move to Bitcoin or whatever else. It's not happening. I'm sure you'll say it'll happen eventually, but it's not happening. But I wanted to just give some views. There's also banks like Morgan Stanley who are giving people views on which stocks are deflation proof. Automation companies like Teradyne, Train Technologies, Smart Rent, and so on. So there's names you can see on screen. When I'm doing this live, what I'd also like to do, and I'm more than happy to do, is answer any questions on asset management, getting into finance, jobs, careers, managing pensions, SIPs, ISAs, all those kinds of things, which as a fund manager, I've got some experience at. So feel free to ask any questions as well that you might have, internships, work experience if you're in your 20s, and for those people who are in their 50s, inflation, SIPs, ISA, pensions, all the rest of it. And whilst I do that, I'll also share on screen, and you can see it there. Whilst I do that, I'll share on screen some of the stocks which banks like Morgan Stanley and others think are recession proof, let's put it that way. So you'll have lots to see during this live on screen as well. One of the many things that caught my eye has been this. Which asset class is the best when you're looking at short-term inflation? Those of you interested in finance, have a look at my campaign for $1million.com. You should be able to see the link there. And you can see over here that whilst people have been going into energy stocks, and yes, they do have some eye-catching high-end returns, but they also have a pretty poor average, and the downside is even bigger. So this is one of the problems. What happens is people end up looking at the name recognition stuff and saying, oh, look, energy stocks, they're doing so great. Look, you can get 36% or whatever. What they forget is as a basket, you're really pretty screwed because the downside's a lot bigger and the average is worse. And depending on your risk reward profile, you might actually prefer US large cap equities instead, which sounds boring, but historically during periods of inflation, they tend to be the better performers on average, also their peak, and also in terms of protecting the downside. What do I think of Reata Pharmaceuticals? I don't know it. I will put it on screen in a second. Thank you for asking. I can do that now that I've got Reata Pharmaceuticals. Let's have a look. Let me analyze that one. Ooh, blimey now. Okay, so that's Reata Pharmaceuticals that you wanted me to look at. Well, it's at a multi-year low. It's at $21, and that puts it back down to what it's been in 2017. And if I was being really optimistic about the company, just looking at the price chart, I'd say, well, when it does that, it has in the past gone from there to jump up quite highly. I'm assuming you got in at a higher level and you're sitting on quite a loss. I'm quite cautious. Who's come in with a buy rating? 3 months ago, Goldman Sachs confirmed a buy. Madhu Kumar. And 3 months ago, Citigroup confirmed a buy on them as well, which is not, it sort of helped them a little bit for a while, and then they've dropped back again. So that's my view on that. Do you offer grad entry level jobs at 3 months? I've done both the virtual internships. At the moment, I've just hired somebody just for temporary work over the summer. But when we're deciding what to do with our funds, we've exited the private equity side, so we're deciding what to do with that. So at the moment, we're not doing grad entry, I'm afraid. We have done in the past. So if we decide to launch a new fund, then we probably will. Do I like Palantir as a company or as a stock? As a company, I think they do some amazing stuff. But as a stock, I can have a look at it. Let me put it up. Palantir. Okay. This is going to be Ask the Fund Manager stuff, isn't it? I'm also going to show you what's going on the screen there. So I've put up Palantir. Where are we on Palantir? Let's have a look at it. Okay, that's Palantir again. We're near sort of IPO prices, or day one of IPO, and it's gone almost 2.5 times higher than this, 3-4 times higher than it is at the moment, and looks like it's forming something of a base. May well start rising from its absolute peak to its absolute trough. It dropped 82%, as you will know. Probably more likely direction going forward is going to be, well, let's hope for your sake it's more likely to be upwards. But the company's relatively solid. You can see something of a move upwards, and I guess that's the trend line you'd want to draw and say that in the next couple of years, maybe it'll double up if you're being cautious. So that's Palantir for me. Hi, Alpesh, don't know if you've done these stocks or not, but PayPal and Amazon. Well, PayPal, I often do. If you look at my Telegram channel and have a look at so that's PayPal. You can see all these buy ratings which have come in from a variety of banks. 8 days ago, UBS confirmed a buy, and so on and so forth. That is now, let me just move those analysts out of the way, that is making something of a V-shaped move upwards, has PayPal. I was saying that in about 1 to 2 years, it would get to 101. It's already done that in the space of a few weeks after having dropped some 77%. PayPal I continue holding for that one, and I'm not saying it's going to continue upwards on that V-shaped trajectory, but it certainly looks like for the moment it's on a pretty high move upwards, far faster than I thought. It's done in a month what I thought it would take 2 years to do. So there we go. Opinion on Fundsmith's recent performance. I've not looked at their most recent performance at all, I'm afraid, but I can in future. Have a look at that. Yeah, your thoughts on EV space, like those companies over the next 5 years. I don't know if you've Amazon. Let's look at Amazon. I'll try and cover the other stocks. I wasn't planning to do it this way. I was going to show you some other charts, but anyway, let's go with what the audience wants. That's my Amazon and projections, and you can see it had dropped 44%, and I projected 65% return in a year, and it's well on target to do that at the moment. Actually, it's again overachieving compared to what I thought it would do. And I'd have no problems with somebody saying, oh, I'm going to get back into Amazon. So I reckon 65% in a year, but it looks like it's moving at a far faster rate than that at the moment. UnitedHealth, UNH. UNH has been one of the most popular ones amongst hedge fund managers, and it's also one which, as well as being, as I say, incredibly popular amongst hedge fund managers, is one which is relatively stable. And as you can see there, that stability has continued. If anything, if I had to make a case against it, I'd almost have to say that well, maybe people will start taking greater risk in the markets now that they might think that inflation's over, and so they might rotate out of this. But you can see the move. It tends to kiss that support line, go up and down, and as long as it's along there, I wouldn't really panic. On that one, it's a relatively safe, low volatility one. How long do I expect this rise? I do not know. I don't know. So that's the way I look at it. If you look at the links in the bio, you'll see my Telegram channel on which you will see my viewpoints. I'll just share some of that on there, where I share my daily updates and so on, and what's catching my eye, what I'm finding interesting, and so on. And so those links are on for that Telegram channel are on the bio, and that's free to follow. And I post stuff on there as well on these. Any other questions? Let me know. And what I'm going to do is this. I'm just going to go back to what I felt is really happening in the market. You look at figure 1 and figure 2. That's the Walt Disney Company, and you know about their figures today. And that's a slightly older chart of it. And you can see it goes through periods of these yellow, where it goes at a really high rate of growth. And then it's got a longer term, slower rate of growth, which is, I've marked figure 1. And as I said, figure 2 are those higher rates of growth that it periodically goes through. And I think with much of the market, it's safer to assume it's going to go at a lower rate of growth than the high rates of growth that we've seen. However, at the moment, stocks seem to be on a quite a bit of a sort of a rip. Oh, is the audio funny? Somebody said that the audio is funny. It shouldn't be as well. Apologies for that. If it is, it shouldn't be. I will have to look into that. So it should actually sound incredibly clear, but I'll look at that. It's echoed a bit. Yeah, apologies, I don't know why it's doing that. I can next time around. I'll sort of try and check that in the future and see why it's doing that and what's happening and what's causing it on the audio. So don't know what to say. Apologies. Let me just pause this for a second and see if I can do anything about the audio. Oh no, I won't pause the live. Right, other questions. I'll just continue in case it's a problem with other people's Wi-Fi at the moment, rather than me. And what I'll also do is remove the link. There we go. So that might help as well. It might be just that there was some audio problem from some of the URL links as well. Now, before we go on to that, one of the things people often look at are, what about index trackers? If the market is going to fall and resume its falls, what about indices, index trackers? Surely they won't do big falls, and you often see people talking about ETFs and trackers and the like on the basis that they're a basket of stocks rather than individual stock. The thing is, what I've shown you here is the price change in the major global indices during the financial crisis. So in 2008, basically, in the year of 2008. And you can see there that the FTSE World Index fell almost 50%. So much for a basket of stocks then. The French markets fell 42%, the Japanese 42%. Hey, wait a minute, France and Japan? Wouldn't I be diversified if I had those two indices? No, because there's increased correlation when the markets fall to the downside. The Nasdaq fell 42%. Hang on, how does the French, the Japanese, and the American tech markets all fall 42%, and the Germans fall about 40 as well? How come they're so highly correlated on the downside? Because that's what happens. You don't get the diversification you think you do by having baskets of stocks and geographical dispersion. It's one of those many things which people are just wrong about. And if you want to know how I know all of this, well, wait for it. Big reveal. Amongst many other things, I wrote, oops, maybe you can see it from over here. I wrote that, published by the FT, many moons ago. Don't buy it, because it's a bit out of date now. It's an international bestseller on trading online. I wrote it, Financial Times published it. So we've done a lot of research on all of this. And I was surprised by that data as well. Okay, that had happened. So I just wanted to share that with you. And again, you might say, well, let's just look at exchange traded funds more generally. Which ones did well? Well, there were some which in the last financial crisis did well. Doesn't mean it will repeat itself. So in a downward market, which ones in 2008, which is this column, did rather well? Guess what? iShares US dollar treasury bonds, 7 to 10 year. They did well. Of course, ultra short QQQ, I don't recommend that. It is very risky. It was up 51% that year. And some of the gold ones, US Treasury bonds at the short end, Euro government bonds, you can get exchange trade funds like that. These are not recommendations or financial advice because I don't know your individual circumstances, so I couldn't possibly give you financial advice. But what I'm saying is, here's some interesting data. There were certain things which did actually go up in the last crisis, but this crisis won't be the same as the last crisis, and that'll be the major differentiator, of course, between the two, and that's something well worth remembering as well. Okay, now whilst you ask questions and send me other questions, what I will do is speak about other things. Maybe fund managers did really well in financial crisis, in recessions, and you might say, well, yes, absolutely, Alpesh. Well, not even the big names like JP Morgan. Most were worse than these, by the way. Here are a selection in 2008 of fund managers, and they were down 26%, 28%, and so on. JP Morgan, who else have we got? Bailey Gifford. There's a lot of JP Morgan funds. Fidelity, BlackRock. So you've got a problem of saying, oh, well, active fund managers will be the way to go. The experts will save us from bigger market falls. It didn't actually happen. And were there any winners in the S&P 500 during the financial crisis of 2008 that we might want to look at today? Well, there were. Actually, these were all the companies in the S&P 500 which were up in 2008, which is not bad. Dollar Tree, still around. Amgen, still around. AutoZone, still a very good company as well. Netflix, you might say, whoa, forget Netflix, mate. That was then. 2008 is very different today. And that's the caveat I'd make. Just because it did well last time doesn't mean history will repeat itself by any means, because the markets and the world's moved on. However, certain things remain the same. People will still use Dollar Tree in a cost of living crisis, and they'll still continue using Walmart. And they'll still need pharmaceuticals. So that is one way to look at it, okay? Yes, you're absolutely right. I will look at the bug in the next one, why it's echoing for the next time, but thankfully it's clear. Now, let me show you some more charts and information. What about the Dow 30 companies? How did they do in the last crash in 2008? Very, very few of the big 30 were up. Amgen was up 24% in 2008. Walmart was up. And McDonald's. And if you look at queues outside any McDonald's anywhere in the world, they seem as popular as ever. So those things, I don't think, will have changed much. Very few went up. But what's telling here is even the biggest companies can drop over 50%. And that's something most people don't realize. They think, oh, it's okay, Alpesh, I bought a basket of big companies. Or I've got an active fund manager. Or I've got an ETF. Or I've got an index tracker. Well, what I've shown you just there, or I'm geographically diversified, that none of those things are actually protecting you very much. Microsoft was down 45% in 2008. Apple was down 56%, Cisco 40%. Okay, Walt Disney 30%, American Express down 64%. Doesn't mean that'll happen again, because again, all crises are different. UnitedHealth Group, I think health insurance, and we just talked about it, was down 54% as well. Okay, have a look at the links in the bio if you want some of the free information and materials that I provide on these things. That's going to be too small to look at, so let me show you something else, and I'll go a bit about stocks and why I actually like stocks. That's some of the big blue chip companies from 1959 to 2010. And you might say, bloody hell, I wasn't born in 59, by the way. Guess what the price appreciation of some of these is? Well, Coca-Cola in 1973, the price peaked to $75 and dropped 60% over 9 years to below 30% in 1982. That's 9 years and you've got negative return. General Electric, price appreciation from 65 to 1980, 0. IBM, 19 years from 61 to 79, market value dropped 65%. This is why I don't buy and hold forever. If you invested $10,000 in Walmart in 2000, then by January 2010, it was worth less than that. 10 years, and it was worth a lot less than that. For many of you, 10 years will be half your life to date. So it's one reason why I don't like just blindly buying stocks to hold forever. What about any crisis in Europe? Do I ever worry about it with my US holdings? No. And the reason is this. That's the United States, or rather a picture of the United States, where each of the states, individual states, it's a little bit dated, but it holds. That shows the economic size of each of those states. So California is about the size economically of Italy. Russia, Texas is as big as the whole of Russia, and Texas could probably take on Russia and defeat them. So I don't really worry about what's happening in Europe in terms of its impact that might happen on the United States. The United States is just too big to be impacted by that on most occasions, okay? So that's my view on that. What about my due diligence checklist when I'm looking at stocks? I'm afraid, as you'd expect, my due diligence is a little bit detailed, but not as detailed as you might think, because you can't forecast the markets with some kind of crazy ability of being 100% accurate. So there's no point trying to take more and more information on thinking you'll be accurate. What you need is sufficient information, and that'll be enough, and then you go out and get a suntan or do something more interesting. And these are some of the things I look at. The ones in yellow are the ones I look at. The other ones are the ones which are available and out there, and just an example of what's out there. And these tend to be the things that I tend to look at. Price earnings growth, price earnings, sales growth, profit growth, cash flow growth, dividend yields, and so on. I don't look at absolutely everything. And if you want to sort of filter companies, there's many free websites out there which will give you tools to to filter. Finviz, this is not sponsored by anybody, but I'm just giving that as an example, and they allow you to filter by valuation. But what I would say to you when you do these screeners is make sure you've ticked the valuation box, the growth box, the income box, the momentum box, the volatility box as well. Don't just look at too few things. You need to look at quite a few things in total. Okay. Advice on how to land shadowing opportunities. Write to a lot of people. When I wanted to get a pupillage as a barrister, I wrote to 100 sets of chambers and I got 2 offers. That was it. 2% success rate out of 100. That's the way to do it. Okay. CPI data. Well, too early to tell. I'm not going to read too much into it whether inflation's peaked. I think there's a lot of wishful thinking in that. It may well have done. Oil seems to have dropped off a bit. What is it? A gallon of gas in America is under $4. First time since March. I wouldn't read too much into short-term information. We psychologically give too much weight to short-term information. Again, going back to careers, and you asked about shadowing. Look, 100 applications I did, and I was organized. I found the names of the barristers' chambers I wanted to apply to. In your case, it might be investment banks, it might be accountants, it might be auditors, whatever else it is. One of the areas when you're looking at, and I can share this now on screen, because I can at long last do this. When you're looking at jobs, and I've helped people get them before, is if you look at something, if you look at the companies which are getting the money. So what does that mean? The companies which are getting the money are the ones which are getting funded. If you look at the ones which are getting funded, then what will happen, for instance, these, okay, if you look on a platform like Crowdcube and see, okay, who's just raised the money, okay, these kinds of companies, then what happens is you are able to decide if you want to apply to them. What 3 words? Monzo, and so on. Free trade, nutmeg. If they're the ones who've raised money recently, then they're probably hiring people. If they're hiring people, they might be kind of companies you want to work in, okay, because they've got cash and they might be in a sector. So have a look at that as well, beyond just the technical side of things as well. Once again, any questions you've got, just let me know. I played around with this thing called follower goal. Well, that's not changing, so great. Clearly, I'm not doing a good job of encouraging you to look at this. I'm not going to go through all of this. What I will go through are some of the more interesting stuff. So this one isn't very controversial at all. It's from Goldman Sachs Asset Management, and it says just how much you should have in terms of stocks and how much you should have in fixed income. Or for that, just read cash. Okay, so let's assume most of you have got 25 years to retirement at least. Maybe you got 35, but it says you should have between about 75 to 100% in stocks, because you've got a long time to go. Okay, if you're closer to retirement, you'd have a lot less in stocks. Why? Well, because imagine you're 1 year from retirement and the stock market fell 30%. Your pension just went down 30%. That's why you wouldn't have it all in stocks. So for fixed income, read cash. And as I said, this is from Goldman Sachs Asset Management. Okay, so a fairly good one there. In terms of number of shares you should hold, this drives some people nuts. Look, once you've got beyond about 30 to 40 stocks, first of all, it becomes difficult to manage the portfolio. But more importantly, beyond that, not only does that become a problem, okay, not only does that become a problem, but also remember, you can't remove market risk. If you want to remove market risk, you've got to be outside of the market. You've got to just hold a bank account of cash. Okay, so company-specific risk is high when you've only got 1 or 2 companies, i.e. risk specific to the number of companies you have. Once you get about 30, 40 stocks, it doesn't change. And I showed you earlier on that just because you had some Japanese, French, and German stocks, it didn't give you the diversification you thought when the markets fall. So just be mindful of that as well when you're looking at things. Now, maybe you want to become a fund manager. Maybe you want to become an active fund manager and underperform like all your peers, but get paid a lot of money to do it. Be my guest. Feel free to do that. But just so you know, they tend to underperform. And the reason they tend to underperform is not just because of fees. The fees are marginal. It's not really that. It's because they're in the marketing business. They're in the business of getting as much assets under management as possible and doing adverts to do it. So Fidelity has, I don't know, $1 trillion under management. So they can't just go out and buy 10 stocks or 15 or 20 or even 30. They've got to divide that money into geographies and styles to divide it up. So they have a narrow gene pool of stocks that they're now picking. They say to a fund manager, you're in charge of European growth. Well, sorry, that only gives me, a couple of hundred companies to pick from, maybe at most 1,000. That's not really a good gene pool to pick from. I want to pick from 10,000. 10,000 is the number of stocks I tend to pick from. And I'll pull that up in a second. Let's see if we can do it here. I've got a button down there, which if I press, magically an Excel spreadsheet should pop up, hopefully, at some point. And I will share that with you in a second. It's not popped up yet. But here it is. Okay, and that shows the, that shows 10,000 stocks. These are all the companies in the United States which are also foreign companies listed there and UK domestic ones. That's the gene pool from which I pick. And I pick a portfolio of about 20 stocks. So I want the best 20. That allows me to filter. When people are looking at a narrow gene pool thinking, oh, they'll get lucky. Worse still, oh, I heard something on CNBC and hoping that one name recognition will help them get better returns. It won't. Like I said, have a look at the links in the bio and you'll learn a lot more. So the issue then becomes is it worthwhile managing your own portfolio? Why not just choose an index tracker? That's fine as well. Index tracker is fine if you're happy to have poor companies. If you want to spend no time ever, just use an index tracker. If you don't mind being locked into 0 or -% returns, because that's what an index tracker may well do, and fear of not beating the